Ladies and gentlemen, we have come full circle. A reporter called Donald Trump a chicken.
I kick out?
Chicken out.
Oh, isn't that nice? Chicken out. I've never heard that. You mean because I reduced China from 145% that I set down to 100 and then down to another number? And I said you have to open up your whole country. And because I gave the European Union a 50% tax tariff, and they called up and they said, please, let's meet right now. Please, let's meet right now. And I said, okay, I'll give you till July 9. I actually asked them, I said, what's the date? Because they weren't willing to meet. And after I did what I did, they said, we'll meet anytime you want. And we have an end date of July 9th.
And now we're back to a full-on trade war with the world, with Europe, with China. So strap in, because this weekend is going to be one of escalation and retaliation. And what does that mean for stocks? Let's talk about it.
Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it.
This is the daily heat map of the S&P 500, and US stocks rebounded from early losses on Friday, capping off a volatile but strong month, with the S&P 500 logging its best May since 1990 and its best month since November 2023, rising over 6%. And we capped off the month of May in what was very mixed price action, broadly green, I would say, held back by some of these big names. Nvidia was down 2.78% on tariff concerns. That's kind of crazy, especially considering the stellar earnings we got from this name. And as a result, the entire semiconductor complex, as well as hardware, took it on the chin as well. Tesla was down 3%. Very weird why. We're going to talk about why that is. And some of the other bigger names like Berkshire Hathaway was down. Most of the financials were down. There was green in some places. Energy broadly fell. Other than that, it was actually pretty green in a lot of other sectors. In fact, most sectors were green here today. It was just that the markets were sort of held back by this space right here, XLK and XLY, with the S&P 500 flat on the day. And this is actually kind of crazy to see these two sectors, right? The technology sector and the discretionary sector down, and the S&P 500 kind of flat. Really goes to show the broad performance that we actually saw in the rest of the market, with industrials, real estate, financials, healthcare, communications, services, staples, and utilities all gaining. Now, the two top performing sectors were staples and utilities, and that is a bit concerning because they are defensive sectors. So you could say maybe a defensive trade is taking place, but we didn't see participation in gold. Maybe that goes to show the market was looking for maybe safety, but also equity exposure and risk, but not necessarily gold as a safe haven. Very weird price action. No real leader today. No real leader this week, but the S&P 500 flat. This kind of gives us a better overview of the market. You can see large caps in aggregate were kind of green, slightly flat, you would call it. Growth in mid caps and small caps as a whole outperformed, and the only real selling we saw was sort of here in this core segments of mid cap, small caps, and then small cap value as well, down 0.73%. That was the worst performing factor segment, but a mixed day. But when you have the large caps outperforming, the underlying fundamentals of your portfolio should generally be green. Now you can see here broadly, we had a mixed day in Europe as well. Asia was very, very red again with the tariff concerns. We'll talk about why. North America was kind of red, but slightly flat, I would call it. South America was mixed, a very mixed to red day globally. And that all stemmed from, the reignition of the trade war. This was kind of starting, at the start of this week, but essentially the US is planning on adding new restrictions on Chinese tech companies shortly after Trump claimed that China had totally violated their trade agreement they made in Geneva. Beijing didn't respond directly, but they did say that the US should cease discriminatory restrictions against China. And this is why we actually saw stocks fall very, very dramatically here intraday. Now, we did put in a bottom pair a lot of those losses, but that was, the major reason. It was just a trade concern and the reignition of the trade war. We also got this news before the open that Trump's team is looking to impose something called a tariff stopgap under Section 122 of the 1974 Trade Act. This will allow for 15% unilateral tariffs for 150 days if the courts strike down the current tariff agenda, just to give them time to deal with the courts. So, the whole tariffs being thrown out, that's not out the window. Trump is also escalating at the same time. There's a lot of moving parts with regards to this trade war. And what added fuel to the fire today was Jamie Dimon. He came out and said there are cracks in the bond market, or cracks in the bond market are coming. He said, you are going to see a crack in the bond market. It's going to happen. That's what Jamie Dimon said at an economic forum on CNBC. And when you have someone as prominent as Jamie Dimon coming out and saying something like that, the market is going to react. But Jamie Dimon hasn't been that great on calling this type of stuff. In fact, we should start calling him the boy who cried wolf, because he's always calling for economic collapse. Now, guys, looking at the economic data today, we actually did get some very good inflation data. If you actually look right here, core PCE came in at 0.1 versus a consensus 0.1. So core PCE came roughly in line. We actually did get the price index also came in line, as you can see, but the year-over-year figure actually came in a little bit cooler than expected, 2.1 versus 2.2%. And like, this is at the Fed's target of 2%. So I don't know why the Fed is cutting. The goods trade balance was expected to come in at negative 141 billion. We got negative 87 billion. So came in lighter than expected. And then personal income, personal spending also came in better than expected. Income growing 0.8% and spending also growing 0.2%. In fact, spending coming in line, personal income coming in much better than expected. This is really, really good. And I showed you some of this data yesterday. Federal employment tax receipts, they were looking very, very strong on a year-over-year basis, up 5% in the month of May. And this is now reaffirmed with the personal income outlays. Super, super strong stuff. And we see spending up 0.2, income up 0.8. The consumer pretty much has more cash at the end of the month. That's very, very good stuff, if you ask me. And then the icing on top of the cake for the data today was here, Michigan consumer sentiment. The expectation was for 51. We came in better than expected, 52.2. And you know, this data right here is probably why we paired those losses very, very quickly intraday. We put in a bottom and then went right back to the highs, finishing net. That being said, Nvidia was down 3% here on the day, simply because Nvidia has a massive China overhang, and if the trade war reignites, Nvidia is going to come in the crosshairs for both Trump and the Chinese regime. And for those of you that want a full deep dive on Nvidia's earnings, you guys can actually go ahead. I did a full video right here as to why Nvidia was soaring after its earnings. We talk about the earnings, the fair value, and is it a buy? And I also have a full update here on Costco, and we're probably going to do one on Dell and Salesforce as well. So if you guys want to go check that out, my channel name is FinFluential Media, at FinFluential Media. I'll leave it in the comments below. Now, Tesla was down 3.46%. And that's because the New York Times reported that Elon Musk is allegedly abusing illicit and pharmaceutical drugs during the Trump campaign trail. Apparently, markets didn't like this, and you saw massive selling. Now, I'm not sure if this report is just rumors or true, if there's any fact to it. These reports have been run previously by the New York Times. That being said, the market was in a sell first mode. And then another major market mover here today was Gap, down 20%. And it actually beat on revenue, beat on earnings. However, Gap came out and said that it expects tariff-related costs of about 250 to 300 million. The company said it had strategies in place to half that amount, maybe some negotiations with suppliers, but it projects a hit of up to 150 million in its full year operating income, mainly in the second half of the year. And the market would rather sell first, ask later, down 20%. Brutal price action for Gap, which is a heavily tariff-exposed name. And then for everything we saw today, there were more decliners, 3,800 decliners, 2,400 advances. We saw inflows in the New York Stock Exchange, outflows in the Nasdaq 100. The S&P 500 was kind of flat here on the day. And market momentum is virtually unchanged from what it was, sort of last week. We have the 5-day, 20-day, 50-day moving average in the green. A lot of stocks above these averages, but unable to retake some of these longer-term moving averages. And ultimately, we need to retake these averages right here if you want to go ahead and hit those all-time highs in the S&P 500. Now, guys, the week just wrapped up, and it was actually a very volatile week, but broadly positive for equities as a whole. You can see the KWEB, or China tech shares, were down 2.68% on trade war concerns, and then Bitcoin was down 4.41%. This is actually what we expected to happen with regards to Bitcoin, and we'll talk about it when we look at the Bitcoin chart. But when you look at equities in aggregate, you can see European equities up 1.28% this week, and like the broad suite of US equities, the RSP, the Dow Jones, the IWM, the SPY, and the Qs were all up in excess of 1.69%, the RSP being the worst performer, the Qs being the best performer. So a very, very solid week. You could see that we sort of just like ripped to the upside early on in the week, and then we sort of had, we paired some of those gains. However, net still up for the week as a whole. Looking at the month of May, what a crazy month. The best performers being the Qs and Bitcoin up roughly 12%. So this is definitely the place where you want it to be. But you saw gains in the S&P 500, the IWM, the RSP, the Dow Jones. Every single name and index on this chart was up. The worst performing being China and the Dow Jones. And again, that had to do with United Health. But even still, up 6% in the month of May. Very solid. And when you look at the results of the S&P 500 and their returns, you could see that this May was one of the best Mays ever. In fact, you have to go back to 1939 last time we had a May this good in the S&P 500. So a very solid return here for equities in aggregate. And then looking at year to date, you can see that Europe stocks and China stocks outperforming, double-digit gains. Bitcoin up in the fold, 8% up on the year. And then US equities kind of flat, struggling to get above these highs right here. A lot of the 100-day moving average is sort of like here. US equities finding resistance at the 100-day moving average. But it looks like the second we break above this level, we probably will go higher. And then the IWM down 7%. So higher beta doesn't tend to do well in trade wars. That is why you're seeing the IWM falling 7%. But absolutely insane that the QQQs, actually up ever so slightly here on the year. Now, looking at what we actually did here today, you could see it was a broadly red day coming off what has been a fantastic week for US equities. So just a little bit of profit taking, probably to end the week, a little bit of de-risking, but nothing major. Looking very mixed here in extended hours. To be honest, most of the selling was capped here in the mid caps and small caps. Large caps actually fared very well today. Europe was a little bit red. In aggregate, this is the stock 600. China was very green, down 2.68% today. Very ugly week for China as a whole. Now, we did see yields act very weirdly. The 30-year yield was flat despite Dimmon's comments. The 10-year yield and 2-year yield actually fell. And volatility, front month VIX ticked up ever so slightly. Again, it's owing to the fact that, shorter term, we're not seeing much volatility, but in the medium term, we can see heightened and elevated volatility. That's what that is telling us. And then bonds, as a result of what we saw, yields gained just a little bit. So bonds acting as a safe haven today. And then we saw, Bitcoin was down, gold was down, silver was down, WTI. So all of like these alternatives and commodities, not the best return. But let's talk about the S&P 500. Now, it's been a very solid week for the S&P 500. You could see that we sort of opened the week right here at these lows, ripped up to the upside, paired some of those gains, but we couldn't retake the 5960 area. This line continues to antagonize us. It's called the call wall. However, we are finding support, multiple support, strong support here at this gamma flip zone. So ultimately, guys, this is what's going to happen next. We either are going to break above here and move higher to all-time highs, or we're going to go ahead and retest the gamma flip and then see if we find support there or move lower. That is ultimately what I think is going to happen next week. We either get a break above the 5960 area or we go back down to the gamma flip. So that's what I'm working on. And I think it's all going to be dependent on what happens this weekend. There was a lot of trade tensions with regards to US and China. If that eases this weekend, I think markets will look at that with a fairly good light. However, if trade tensions continue to escalate, if we see, further escalation from China and the US, and that's probably going to come from the US side, in my opinion. China seems to be just reactionary to everything. So if if Trump escalates, then we probably will open Monday pretty red, in my personal opinion. But don't try and predict what's going to happen. Just react to the market as it happens. And if you guys want play-by-play updates this weekend on my Twitter, FinFluential X, I'll leave it in the link below. You guys can go ahead and just follow me there, and you'll get all the latest updates. But yeah, that's what I'm expecting next week, guys, with the S&P 500. Also, with the Nasdaq 100, very similar situation. We're either looking for a break above or the gamma flip to act as support, depending on what happens with the trade war and the trade situation. I think the Russell 2000, this is very ugly price action. In that case, we're just going to look for the 2000 level. I think we're going to continue to see selling unless we actually get a very firm trade negotiations. Otherwise, I think, people are going to sell these high beta, high risk assets and go into stuff like the large cap indexes, especially if they want, equity exposure. It's just a safer bet with regards to everything we've seen at the moment. What's very weird is that despite trade tensions, gold didn't act very, very well. And that probably reaffirms the fact that we are probably going to go ahead and retest this level right here. That being said, we are seeing price digestion and consolidation at these highs right here. This is a very, very important level, the 3,300 level, because, when you're seeing the bears, we know the bulls win, and whichever side goes, you're going to see capitulation and follow through from there. And then looking at Bitcoin did exactly what I said it would do this week. I said we're probably looking for some form of a pullback from these highs. I literally said that in the weekend video last week. That's exactly what we got. What are we looking for next week? I think Bitcoin is probably going to outperform. I'm heavy long Bitcoin right here at the sort of like the low to mid 70,000 region. And I probably will add if we get some good news on Monday. I didn't add any Bitcoin today. I may just sell some like in the money puts for something like IBIT. You can get $1, maybe $1.50 for that. And if we do see like a day where we consolidate, that'll just add to my Bitcoin exposure for that week. If not, I guess you just close the puts and write out, the exposure you have. That being said, if we look at global M2 money supply, and for those of you that don't know, this is M2 money supply. This is the price of Bitcoin. And when you lag it by 80 to 100 days, depending, right, you get what Bitcoin's going to do next. And you could see that Bitcoin, we still have a long way to go with money supply. And money supply continues to make all-time highs, as you can see right here. Pulling a little bit back, but inconsequential. And I think we're going to continue to see all-time highs, especially as once the spending bill passes the House and some of that money starts getting put into the markets. I think, then you could see tangible upside to this number. But right now we're looking for about 150,000 mark for Bitcoin. And again, from where we are right now, let's call it the 100K, right? You're looking at 50% upside from where we are right now. So guys, continue to hold the line, sit through the volatility. Bitcoin is a volatile asset. You can have weeks where you go down 4%, and it could be anywhere from 4 to 10%. Hold the line. Bitcoin will go higher.
And guys, let's talk about sentiment. This is the Fear and Greed Index. It essentially tells us what emotion is driving the market right now, and it is greed. And we've been in this greed zone for quite a number of weeks, especially as we've come off the Liberation Day lows, rallied up. However, in more recent time, we have not made headway into extreme greed. In fact, we've moved closer to the neutral territory, and that is really telling with regards to the price action we've seen. This rally we've had has sort of stalled here. We are digesting everything, and when you do get a little bit of digestion, you are going to see sentiment pull back ever so slightly. That being said, things are bullish. People are buying stocks, but not everybody is buying stocks. In fact, the only people buying stocks are corporate investors. In other words, companies buying back their own shares, share buybacks, right? They were the biggest net buyers of stocks last week and in the last 4 weeks. And then retail traders, they are also net buyers of stocks in aggregate. However, net sellers include hedge funds and institutional investors. In fact, they were huge sellers last week of stock. That is sort of looking like a silly move now. They probably thought that we were going to go lower. In fact, we sort of just found support, ripped our way back up to this 59.50 area. Now we'll see what happens next week if we go above that and reach those all-time highs, or will the hedge funds and institutional investors be correct in decreasing their loan book or even selling short to some degree. That being said, I think over the next couple of weeks, we are going to see who is correct. Is retail traders the smart money, or are hedge funds and institutional investors, will they continue to hold the trope of smart money? Right now, retail, us, you and me, we are the new smart money now. And you know who's also buying stock with us? Insiders. The insider transaction ratio remains in this bullish territory, and it has for the better part of 4 months, telling us that insiders see value with where stocks are right now. And investors this year have instantly been rewarded for buying the dip in 2025 with the highest return in more than 30 years. In fact, this is average S&P 500 return in the session following a down day. We're looking at about 0.35% after a down day. So literally buying the dip in 2025 has been the meta. It has been the play. And here is a CT scan of all the individual, retail, and insiders that have bought the dip and bought the Liberation Day lows. Call it diamond hands. Now let's talk about the macro, guys. Yesterday we got GDP data, and what's very interesting, GDP for the first quarter was tracking at negative 0.3%. Now it's at 0.2. So we actually saw a beat in revisions. Very, very healthy stuff. We may actually see revisions get to 0.1 and maybe even 0. And if that is the case, that will be super, super bullish, because then we didn't have a negative quarter of growth. But as it is right now, negative 0.2% growth in Q1 GDP. Something else that's looking really, really good for the bulls at the moment is this right here. Federal employment tax receipts for the month of May has clocked in at 5%. Very, very strong. So in other words, if the Fed is receiving 5% growth in federal employment tax receipts, that is a direct correlation to say that disposable income and employee compensation is tangibly higher. And you see 5% growth here in employment tax receipts when inflation is only at 2.3%, at least in the PCE. That is telling you everything you need to know. The average consumer is actually gaining buying power against the rate of inflation. And that's part of the reason why the buying has been so strong. When you have that type of environment, consumers are flush with cash normally, and that cash does make its way into asset prices eventually. Now, there are some bad-looking data points that we do need to be aware of. For example, flows into early delinquencies. Look at student loans up 8.2% right here after Trump said you have to pay your student loans. You saw a massive, massive uptick. Now, this can hurt the consumer, but to be honest, it's mostly going to hurt the lower end consumer more than it is going to be that middle and upper end consumer, especially because these are flows into early delinquencies, delinquent 30 days. Even though this is a massive tick up, it's still tracking at about the average. It's nothing major to be concerned about. I think it might just be short-term pain when it comes to money supply, spending, and income. Looking at data next week, guys, we have a big week of data. We kick things off on Monday with the ISM manufacturing data. Then we get the jobs opening. So this is kicking off the week we're going to have with the employment data. Then on Wednesday, we have the ISM services. And then on Thursday, we have the initial jobless claims. It's not here. We also then have the ADP report on Wednesday as well, guys. And then non-farm payrolls and the unemployment rate here on Friday. The non-farm print, the consensus is 430,000 and a 4.2% unemployment rate. And then for jobs opening, we're looking for a 7.05 million number. So we're seeing a slight decrease there in job openings. Earnings next week, there isn't really much of anything here on Monday. I guess Credo Technologies is one name you can look at. We do have quite a number of dollar stores, Dollar General, as well as Ollie's here on Tuesday before the open. Dollar Tree Wednesday after the open. We also had Neo, and then CrowdStrike and HP Tuesday after the close. Then Wednesday after the close, we got MongoDB, Five Below. That's another dollar store, by the way. And then a couple of other names that aren't of consequence. And then on Thursday, the biggest name of the week after the close, ABGO, along with Lululemon and DocuSign. And then nothing here on Friday as well. So a very, very big week of data, a mild week of earnings, but there is some big names that can definitely move the market. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.